Hello and welcome to BloombergQuint. The RBI/MPC monetary policy review was all about liquidity, as everyone had anticipated. There was no change in repo rate, the reverse repo rate, which there was a small section of the market thinking that it's time to up that rate, has also been left unchanged, as has the stance. What has changed, though, is a stopping of DSAP, which is a program under which the RBI has been buying bonds, government bonds from the market. They've also stepped up what is known as variable rate reverse repo auctions. Joining us to talk about what the market took away from that and the signals for policy ahead are Sivakumar, Head of Fixed Income at Axis Mutual Fund, and Kaushik, Chief India Economist at Deutsche Bank. Thank you both so much for taking the time to speak to us. Siva, I'll start with you and just try and get a sense of what signals you took away. There was a bunch of stuff, no change on rates, one MPC member still wanting a move on stance, the RBI starting to move on liquidity, but trying to assuage the markets that they're not really moving on liquidity. What did you take away?
Hi, Ira. Good afternoon. First of all, I think it was a policy decision which was mostly on expected lines, which is why we didn't get too much of reaction from the markets. Having said that, yes, there are a few things that you must read between the lines. Firstly, of course, as you rightly pointed out, it's an RBI stroke MPC monetary policy because most of the decisions were not in the MPC. The MPC actually, as has been the case for the last several meetings, largely sat out of this one too, leaving the rates unchanged and policy stance unchanged. And it was up to the governor and the members of the RBI who made a decision, some of the critical decisions. I think two or three things stood out for me. First, I think is the emphasis on withdrawal of liquidity gradually. And gradually being the operative word. They're doing it in a very, very, very slow manner. They're still not quite confident that the economy is back on full track, and therefore they don't want to do anything that upsets economic recovery. So that's the first thing. So, but nonetheless, a clear trajectory that liquidity is going to get tighter and that eventually rates are going to go up. I think that was my key takeaway. I think the path for future rate tightening has been set. The emphasis on the variable rate reverse repo and today's cutoff, for example, on the weighted average rate on the variable rate reverse repo at 365 further says that the RBI is quite comfortable in allowing short-term money market rates to trade well above the reverse repo rate, as a fixed reverse repo rate. So that suggests to me that RBI is setting the stage for tightening liquidity, which eventually leads to a rise in the reverse repo rate. So I think this is one of those policy statements where not much is done, but I think the direction has been set for the
future. Kaushik, same question to you first. Your key takeaways.
Okay, hi. So I think RBI has acted like the Fed. If you think of what Fed has signaled to the market in the last few meetings, what they've said is that we'll start a tapering of the asset purchase program, but don't take that as a signal for timing for rate hikes. Obviously, they have a dot plot, and you can try to figure out what is the median dot plot. But they're saying trying to delink the decision between tapering of purchases and rate hikes. So in India's context, what RBI is trying to do is start with the normalization process, which they have already started, and the liquidity absorption actions that they have taken. But they're saying don't try to use this as a kind of indicator for potential. In India's context, it will be repo rate hike. So the stance will only change if you think that the repo rate hike is going to happen anytime soon. But even without the repo rate hike, we know that there could be a lot of normalization that can be done at the reverse repo end, and that's where the VRR comes in. We always had a view right from the beginning of the year that the transition would happen as such that you will try to get the marginal cost of liquidity absorption increasing slowly higher than that 335, so that at one point of time, majority of the liquidity is getting sucked at, say, on an average 355 or 365. Then at some point you'll say, what's the point of keeping the operative rate at 335? Let's raise it to 355. So I think we are at that stage, and we expect that in December RBI will be hiking the reverse repo rate by 20 basis points from 335 to 355, while keeping the accommodative stance unchanged. So that is important. So just like the Fed, RBI will kind of make it a point to tell the market that we are going to do this normalization process gradually, very gradually, while keeping the accommodative stance. And that will only change when we are sure that we can give some signal to the market of potential repo rate hike, and the stance is linked with the repo rate. So we think that February, if everything is fine, you don't see a third wave, and even after the festival season, growth is kind of chugging along the forecast that RBI have given. then they can change the stance to neutral in the February policy after the budget and pave the way for a potential repo rate hike. But by that time, they would have finished doing the reverse repo rate hike and narrowed the corridor to that 25 basis points between repo and reverse repo.
Okay. I'm going to get into the weeds a little bit on this VRRR, Siva. Is it really absorption at a 7-day or a 14-day tenor? Even by the RBI's own liquidity framework, it's not really absorption. If they wanted to signal that, okay, we are going to start pulling back this liquidity, should they have at least balanced out between 14 days and 28 days? I know they've opened the window to 28 days, but given the very heavy calendar of 14 days, I'm not sure how quickly they'll move to or insert a 28-day VRRR right now.
I'm not too sure whether the RBI thinks in those lines. I think the RBI is quite neutral about the tenor of the results. So they are only looking at these various different repo tools more from an operational perspective and not specifically from a perspective of that we are sucking out liquidity from 14 days or for 14 days or 28 days. I think it's more of an operational, they're looking at an operational way, and it is staggered. So for example, you go back to the start of this year, we didn't even have the 14-day VRRR for a while, right? So with the reintroduction of that in January, it was a shock to the market that RBI is actually thinking of withdrawing liquidity. And now we are, discussing routinely as if, 7-day, 14-day, 28 days. So the RBI has achieved that objective of moving the discussion away from, excess liquidity and rate cuts to a point where we are happily discussing what should be the cutoff of the variable rate reverse repo and how much above the 335 it should be. So to that extent, they've actually managed to successfully transition the market away from this obsession over the 335 into, I think, what is a market-determined, at least partially market-determined short-term interest rate. The other point is that, of course, the 14-day reverse repo rate is supposed to be technically the RBI's chief tool from the perspective, for example, going all the way back to the Kaushik Patel committee, the 14-day cost of 14-day money in that sense was supposed to be the key policy too. So yeah. I think from the RBI's perspective, I think the 14-day focusing on the 14-day reverse repo or the 14-day repo, as and when we move to that liquidity deficit mode, should be the right path going forward. And the shorter windows, the 7-day or the overnight, should be only seen to balance the near-term cash mismatches in the system. So the large chunk of outstanding refinance should happen, whether it is on reverse repo mode or repo mode on the 14 days. So I'm just now getting a little bit really into the weeds of this. And I don't think, therefore, the RBI is really signaling anything by using either the 14-day or the 28-day tool, except, like I said, so far as to move the discussion away from 335.
Kaushik, is that how you see it as well?
Yeah, I just wanted to come on this and, so I have a strong view that even before December 8th policy, you'll see 28-day VRR, being announced. They just didn't do it today because it would have been too much because they have, not announced the GSAP program. Together with that, if they had done 28-day, it could have been taken more negatively. As you said, they have kept the, door open for a 28-day VRR. So what could happen possibly is that the 7-day VRR that they're doing, the 2 trillion, that could reduce, and then slowly they can, transition to the 28-day. So as Shiva said that, 14-day would be the maximum, and going up to December 3rd, you're going to go to 6 trillion. The 2 trillion that you have on the 7-day can slowly transition into the longer end of, 2 trillion, and you have then 8 trillion getting sucked out of 14-day and 28-day. Now, the point is, if you see RBI's 2020 liquidity framework, what they say is that up to 14-day, it is considered as dealing with transitory liquidity and frictional liquidity. Anything above 14-day, it will signal they're dealing with, a durable liquidity management. And probably RBI did not want to give a signal immediately. But, market is obviously reading through all this, VRR cutoff that is coming. And, in their head, I think market has already prepared for a potential reverse repo rate hike by December of 20 basis points. So that pricing is important, because if that pricing already happens, so in December, if they do a 20 basis points reverse repo rate, it will not mean much because market is already prepared. That pricing is happening right now, or it has already happened a few weeks before when we got that 399 cutoff on the 7-day. So this is an ongoing process. Only thing is, October is the festival season. Luckily, last time we did not see any spike of COVID cases after October. And then, things became bad in February, March onwards this year. This year, if we manage to have October, November looking like more stable on the COVID front, I think December is a reasonable time period for RBI to do the reverse repo, because by that time, remember, the Fed would have already announced that tapering, and that would be the ideal time then RBI to also start the reverse repo normalization.
Okay. I'm not asking a question on GSAP because I think everybody would agree that, under current circumstances, continuing with GSAP would just, have rankled. But, I want to ask you on, what sort of you're seeing in terms of the implications of this liquidity. I think there's been a lot of talk around the CP market fueling, say, the IPO rush. Then there is other conversation saying that large corporates are managing, to get higher limits to borrow via CPs, and that's one way that this liquidity is, fueling some imbalances. Is there any clear signal to you of this liquidity having detrimental impact right now in the system?
I'm not altogether clear that there are any signals of real detrimental impact, but you must remember that when you have such a large amount of excess liquidity, that liquidity will find its way somewhere. And if the current demand for that excess liquidity is in the equity capital markets or in other speculative assets, then that is where it will go. So the policymakers now are faced with two choices. If they want to curb that, they can put sector-specific restrictions, maybe increase risk rates, but then it's a case of whack-a-mole where you keep increasing the sector's limit somewhere and then the liquidity finds its way to a new speculative asset and then they will go after that and so on and so forth. Alternately, they start actually bringing down the excess liquidity in the system. Which then leave it to the market to price the relative risks of the different sectors. And I think that's the right way to do it. I don't think the RBI is equipped to go after every sector where there may be a speculative excess, where the liquidity is finding its way to fueling speculative excess. And I don't think it's not the RBI's job to do that. I think the right approach would be to control the overall liquidity and then let the market price. But yes, the fundamental point holds though, that with such a large amount of excess liquidity out there, it does make it cheaper to do speculation. Yeah. And we have seen this in the past where, where high amount of excess liquidity finds its way, for example, into at some level excess leverage. Today, we are fortunately not there. And therefore, it's not an immediate risk, but persistent easy liquidity can lead to systemic issues in terms of increase in leverage, etc. We're far away from that. So I wouldn't want to send a signal that we believe that there are such stresses in the system. I think we are, well controlled from that respect.
Kaushik, from the more traditional fear that liquidity will, fuel inflation via the credit growth channel, again, we are some distance away from that because even at, say, 6.67, which is the current year-on-year credit growth rate, it's quite tepid.
Yeah, so before I come to that on this liquidity question of this distortionary impact, the thing is, RBI has said that they'll not, discontinue with the GSAP program, although they have kept it on the table. They have said we'll do Operation Twist if required, or OMO Twist. I think they'll have to do it. I mean, there's no other way. The only difference is they're not announcing it right now that they're going to do 50,000 or 70,000 crore for the quarter, October, December. But this is not a situation, if you see the market, that RBI can just go and not do anything. So they will have to announce Operation Twist or OMO Twist. And the amount for the quarter, in my view, would be close to that 50,000 or 70,000.
Why? Because long-term yields are rising.
Yeah, because you have to support, right? I mean, because see what is happening globally. You have US treasuries going up. You have oil going up. You have, suppose you are bullish on India's growth prospect. If you see RBI's growth forecast, they have increased for July, September from 7.3 to 7.9 and from 6.5 to 6.8 for October, December. So they are generally being more bullish about growth for the next 2 quarters. So if you are being bullish, then, and if you are expecting the normalization will start 3 months, 4 months down the line, there will be pressure on the longer end as well. Now the point is, today the 10-year is at 630. Where will you be comfortable? If it goes to 650, will you still be okay? And will you let it go? And within what period of time? So that time frame is very important. To that extent, I think whether RBI, there's no difference in my view about GSAP and OMO purchases that they used to do earlier. It's just that they are telling you in advance that I'll do this much, and that will come as and when they feel that the curve has stiffened too much. So I think overall you'll still see support coming from RBI in the form of Operation Twist or OMO Twist, not to add further to liquidity, but as Governor said today, we are already having an overhang of 13 trillion INR worth of liquidity. Now, credit growth, as you said, it's kind of on the lower side. So there's no fear of that, fueling inflation immediately. But these things don't happen over a, very short period of time. It takes time. So you are supposed to kind of nip it in the bud. And monetary policy always works with a lot of lag, right? The transmission. So if you have to take a call on today's policy, you'll see 6 months down the line, what is your expectation of credit growth? So if you are giving a growth forecast of 17.2% for April-June quarter, you have to think from now what will be the step that you need to take, because the monetary transmission will take a lag and you don't want to shock the market in the first place. So that's why I think, and the other thing which the one more key takeaway, if you see, they have reduced the inflation forecast, right, for from 5.7 to 5.3, but the January-March quarter, they have
5.8.
5.8. So RBI is still not confident that inflation will come down beyond this momentary thing. And given what is happening globally, the fuel price surge, if the government doesn't cut excise duty, so they're working with a higher inflation number and they're working with a higher growth in quarterly profile. So the 10-year bond yields are bound to go up if they don't do any kind of support. So I think it is sooner or later that you'll get an announcement of Operation Twist or OMO Twist coming, in this quarter.
So how much can yields go up, and will they intervene? They seem to have backed off from the 6% obsession, thankfully, but there may be a new level of obsession which will creep in.
I have a slightly different take on what the market reaction is likely to be in the absence of GSAP or the market's already pricing in a lot. So if you look at either the GSEC curve or the AAA curve or the OIS, which is a non-funded curve, the amount of rate hikes that is being priced in is quite extraordinary. So we're looking at what market is already pricing in an operative rate of closer to 5% in the next couple of years. So effectively, the markets, if you look from a market pricing perspective, the market's already working with the effective overnight rate of close to 5% in the next couple of years. So unless we really believe that the RBI is going to tighten more than that, really speaking, there's no sustainable sell-off in the markets that's going to happen. Yes, you may see some relative price changes. Long bonds may outperform or underperform relative to short bonds. In my opinion, the curve will flatten with short yields rising more than the long yields as the monetary transmission happens. Long-term yields have already priced in a lot of what is to come. The curve is already very steep. So what that suggests to me is that actually, in that sense, the market's already well prepared for the next course of our action from the RBI, and RBI really doesn't need to support the markets at this point of time. If the fiscal consolidation also proceeds quite well, and that's where RBI really has some relief right now, because tax collections being what they are, there's little risk of an upside surprise in the fiscal deficit, or whatever you want to call it, negative surprise on the fiscal deficit. So therefore, they're in good shape. The second point I wanted to sort of have a different view is what implications this change in the RBI's near-term inflation forecasts. It has absolutely no meaning on monetary policy, because by the time this inflation forecast plays out, this will be already in history. We are talking about, and even if we go with Kaushik's time frame, which is to expect rate hikes, let's say between December and February, by the time February happens, we are already looking at the next year or the year after inflation forecast. So inflation forecast for fiscal year 22 has no further role to play in monetary policy decision making. Really what happens is, what's the inflation forecast for FY23 and FY24? And we heard Dr. Patra's speech where he mentioned that inflation is expected to average closer to 5% in FY23 and probably get to 4% in FY24. I'm assuming that what Dr. Patra says is with reasonable monetary action. So this is not with current interest rates, but with whatever thought process they have in terms of the future path of monetary policy. So like the Fed dot plots, in a sense, you assume certain monetary policy actions will follow. So I think the way the markets are looking at is, first of all, near term, doesn't matter what the inflation or question is, will 5% or lower inflation be achieved next financial year? I think that becomes critical, because that then determines whether the repo rate will eventually top out at 5 and will not rise above that, assuming that positive real rate at the short end is the objective. So therefore, 4.5-5% effective operative rate. And if that actually happens, then GSEC yields will not rise or will not rise materially, and therefore it completely takes the risk out of RBI's hands. I think so. If all of this plays out well, I think we are in really good shape, especially as far as the long end of the curve is concerned. Of course, short rates will go up or not, because short rates are dependent on liquidity and overnight rates, and I think that's where most of the pain for the markets will be, and it's not going to be at the long end.
Okay, a quick word each on inflation and growth. Actually, I'm glad you brought up Dr. Patra's sort of glide path. Kaushik, now, frankly, I'm confused. We had a inflation target. So earlier one could judge whether the RBI or the MPC rather would react if inflation was moving above a certain point and they wanted to bring it back towards the midpoint. Now Dr. Patra has given this new glide path, but it's Dr. Patra who's given that glide path. Should we now benchmark expected reaction function of the MPC to that glide path or what?
No, so it depends. Like, where do you see medium-term inflation, right? I mean, as Shiva said, there would be all this volatility in inflation because of vegetable prices in the short term, then it will correct. That is not the way to figure out what RBI will do over a period of time. So we have all these econometric analysis which we have done, and basically we have come to the conclusion that post-COVID, India's average inflation would be about 5 to 5.5% from FY23 onwards. So you should work with a 5.5% inflation average compared to the 4% target that they have. So there will be 100 basis points bump up because of the supply chain issues, and it will take time. And we don't know what will happen in FY24. We don't even know what will happen in the next 3 months. So no point talking about FY24. But I think inflation on an average is going to be about 5%. And if you think about the headline inflation, you'll see headline inflation and core inflation will converge at some point of time. And you will see when I talk about core inflation, it's after stripping out that petrol and diesel, not the one which RBI uses, which is at 6%. So that should be around 5%, and headline will also be about 5%. So that will be the new normal for India. Now we have a 50 basis points repo rate hike next year, 2022 calendar year. So if the repo rate goes up to 4.5, so the operative rate basically goes up from 335 to 4.5. That's almost 90 basis points increase. So 4.5, even if your operative rate is the repo rate, say next year sometime, then also your real interest rate stay negative by 50 basis points if your inflation is averaging 5%. We have a terminal repo rate at 5.25 to 5.50. That probably will be reached sometime in 2023 or 24, not back to the 6.5 that we are used to. So we have already built into our calculation that RBI's real interest rate would be barely 0 to 50 basis points. They would not want to keep it negative for a long period of time. Maybe next year it will still be on an average negative, but from FY23 it will go up to say 0 or 50 basis points. So you could have terminal repo rate probably going up to 5.25, 5.50, and then if inflation is averaging 5%, you have 25 to 50 basis points positive real interest rate, which is required to not have distortion. To Shiva's point, I think what he said is right, that market is pricing in too much. And if we have a view of terminal repo rate at 5.25, 5.5, do you have a risk of market pricing in higher? So therefore, whether yields will go up further or not. And one more supportive factor which can come, it obviously depends on the timing of the announcement, is the global bond index inclusion.
Yeah.
Whenever that announcement comes, that will be worth 15-20 basis points probably downside in bond deals, just because of the positioning and expectation. And it will be a fundamental change in the fixed income market. So we are hoping that it will come first quarter of next year sometime. So RBI has built in all this on balance and thought that at this moment, it's okay not to do the GSAP commitment. And as and when we think that yields are rising too much, then we might come in and do something.
What is it they say? Waiting for Godot in the inclusion in the indices. Okay, Siva. Actually, the point about sort of real interest rates that probably links back to J.R. Verma's argument at the last MPC minutes as well, right? You start withdrawing the emergency accommodation, and perhaps you'll be able to retain repo at a slightly lower level to give that sort of fillip to growth beyond a certain point. Are you in sync with that argument?
Yes, I am. I think. The core argument in this is something like what's called the hysteresis effect. That if you allow inflation to remain elevated for, let's say, a couple of years, and remember that from December 2019 till date, the average CPI inflation is about 6%. So we're already now nearly 2 years of average inflation at 6%. So if we allow inflation to remain, let's say, 5.5% or whatever for the next year also, we're looking at potentially 3 years where the inflation rate is 5.5 or higher. And that will create significant challenges because inflation expectations will get reset higher. The big advantage that RBI had going into COVID was the last 4 or 5 years where the average CPI was just 4%. Therefore, they could take, in some sense, extraordinary measures without risking a blowout in bond yields. So the 10-year GSEC is still at a little over 6%, which is roughly where it was pre-COVID. So if you go back to Feb March 2020, the 10-year was at about 6.25. So for all the extraordinary measures, increase in fiscal deficits, etc., that have happened, the long yields have not risen. Or have not risen disproportionately because there's still some belief that inflation will get anchored. That is to say that if inflation on average is 4%, then 6% on the 10-year makes sense. But if the market comes around to believing that on average inflation is going to be 5 or 5.5, then the 10-year will have to start drifting closer to 7 or 7.5 because the real rate on the long bond should be, let's say 2% or whatever that number is. So the risk for the RBI, and I think that's exactly where Dr. Verma is coming from, is that the longer they allow inflation to remain away from 4%, the more they will have to do eventually to claw that back. So, and I think that's the risk he's highlighting, and I think he's absolutely right. I think Professor Verma is absolutely right in highlighting that risk. So take smaller actions today, rather than take much larger emergency actions in the future. This is the same mistake that RBI did in, let's say, the 2012-13 period, where where rates were. You have to remember that in 2010, 11, 12, the RBI was doing OMO purchases of GSECs despite double-digit CPI inflation.
Yeah.
Right. So you had an RBI which was so accommodative that then allowed, and then of course they had to retreat and have this sort of 2013 emergency rate action. I think what Professor Verma is really highlighting is let's not go down that path.
Yeah.
Now, of course, what really plays into RBI's hand this time is we don't have an external sector problem. I mean, at the peak of the last cycle, we had, I think, 4% current account deficit, and that was largely funded through short-term liabilities. And therefore, when you had the taper tantrum, those liabilities created challenges for the currency. And so we are not in that position. So I think the RBI can finish this time. So to extend this a little bit longer and then play this, I think it's a fine walk, but I think they can manage it.
Fair enough. Kaushik, last question. Between the risk to inflation, particularly from input costs, commodities, etc., which may feed in, versus the uncertainty of growth, given that we don't know how the pandemic plays out, etc., which is heavier on the balance right now?
See, in this kind of a COVID situation, growth will always be a bigger problem to forecast. Because in December 20, when people were forecasting for 21 or FY22, everybody gave 12% growth. I mean, we were lower because we were more conservative. But the point is that you don't know whether their third wave, maybe it doesn't happen in October, December, but it happens in January, March. So this is the nature of the problem. And that is why RBI is being cautious that I don't want to move too fast and then, suddenly something happens, I have to again reverse the whole thing. It's better to be, kind of going on a basically reacting rather than, being proactive. So, and this is what is done by many other central banks, those who don't have that external, support, that kind of reserves, or they have a problem on the currency like the Latin countries. So to that extent, I guess growth will always be a bigger issue. Inflation, you can still just think about it. I mean, government, if they cut excise duty on petroleum products, that can give you a lot of, relief in the short term at least. But the point is that supply chain issues will remain for some time. We are seeing it globally, and that will be also there in India. So growth will definitely be an issue. And the problem is that it is not going to be a straight line as per straight line projection. So suddenly after 2 quarters, when things are okay, you could suddenly see a dip because cases are going up again despite the double vaccination. So that risk is always there. But I think the argument that people sometimes make, okay, we have close to 700 billion FX reserves now with the forwards and everything. That is why we can keep real interest rates negative. It doesn't matter. It matters. Real interest rate should be 0 or positive, because that is how you get those stories about distortion that you are talking about. And it just starts from one place, and then, as Shiva said, that you stop that leakage, it goes somewhere else. And once you have allowed that 13 trillion to build in, how will you reduce the level of liquidity without a CRR hike? I'm not talking about absorption. What we are talking about with VRR is just absorption for a longer. So Dr. Patra is saying maybe credit growth will go up over a period of time. Naturally, it will come down. We don't know how long that will take. So then you'll have to either do a CRR hike or you'll have to do almost sale.
Almost sale. Yeah.
But these are all going to be disruptive for the market, right? So you might as well not allow it to go up that much in the first place. And there is no empirical study to prove that this 13 trillion is adding to 50 basis points additional growth, and 7 trillion excess liquidity would have led to lower growth. So are we going too much on the liquidity side? That is something which we all keep in mind. And that's why the longer tenor VRR, I think it's coming even before the December rate policy, at least to absorb liquidity for a longer period beyond the 14 days.
Okay, I think as Jahangir Aziz said in a recent conversation, they've got a lot of balls up in the air. They haven't let anything crash yet. So maybe we should give them a little bit of credit for that and see how it goes. Thank you both so much for taking the time to speak to us here on Bloomberg.
Thanks, Ira.
Yeah.
Thanks for watching.